Good afternoon, Ms. Shantini. My name is Ahmad Shahur, and along with me are my colleagues Abdul Habib, Esther Francis, and Joanna. So before I begin the presentation, let me show you the table of contents. So I will begin with the introduction of foreign exchange and money market, followed by Esther, who will talk about factors that contributed to the patterns change in foreign exchange. And after that, effects of changes in foreign exchange rates will be discussed by Joanna. And then lastly, the techniques to minimize foreign currency exposure will be talked about by Habib, and I will follow with the conclusion. So moving on with the presentation, what is foreign exchange? So basically, foreign exchange is the exchange of one currency for another. It is also known as forex. A nation's currency gets valued in a free market against other currencies such as the US dollar or even to a pool of currencies. The government of a nation may also determine the value of its currency. So there are different foreign exchange markets related to the type of product that is being used to trade in the forex. These include the spot market, the futures market, the forward market, the swap market, and the options market. The functions of foreign exchange are to facilitate currency conversions, to manage foreign exchange risk through futures and forwards, and for speculative investors to earn profit on forex trading. So what is the importance of the foreign exchange market? These foreign exchange markets serve an important function in society and the global economy. They allow for currency conversions, facilitating global trade, which can include investments, the exchange of goods and services, and financial transactions. So moving on to money market. The word money market is a generic term that encompasses a variety of market varieties that differ based on the requirements of lenders and borrowers. Money markets allow borrowers to gain access to cheap financing, as well as a mechanism for those with cash to make safe, liquid, short-term investments. Money market instruments, many of which are securities, differ from one another in terms of how they are dealt with, how they are handled by financial regulatory rules, and how much the value of the underlying collateral is relied upon by the lender rather than an evaluation of the borrower. Money market consists of negotiable instruments such as treasury bills, commercial papers, and certificates of deposit. It is used by many participants, including companies, to raise funds by selling commercial papers in the market. Money market is considered a safe place to invest due to the high liquidity of securities. It has certain risks which investors should be aware of, one of them being default on securities such as commercial papers. Money market consists of various financial institutions and dealers who seek to borrow or loan securities. It is the best source to invest in liquid assets. The money market is an unregulated and informal market and not structured like the capital markets, where things are organized in a formal way. Money market gives lesser return to investors who invest in it, but provides a variety of products. So now I will hand over to my friend Esther, who will continue with the presentation.
Okay, thank you, Ahmad, for the good introduction about the foreign exchange. Now, moving forward, I'm going to discuss the factors that contribute to the patterns and change of exchange and of the foreign exchange, starting with the first main factor, which is the interest rates. The interest rates can influence the exchange rates in the meaning that when the interest rates rise, the investors will rush to take advantages of the high returns in the particular countries where the interest rate has rises. This also will increase the demand of that particular currency and making its currency being pushing up in relative to the value of the other currencies. Okay, the second factor that influence the pattern of the exchange rates is economic growth. The economic growth of the country, as well as its strength, can impact the foreign exchange rates. When the country's economy is strong and growing, there is often more demand of its currency in purchasing of the goods. We can just say a good example, the US dollar, which is used mostly in purchasing like from business people in different countries. When they want to make purchase, they will have to change their money to US dollars to make the purchases. So this is highly contributed by its economic growth and strength, whereby this makes its currency to be pushed up its value against the other currencies. Okay, moving forward to the third factor, which is political stability. Political stability means that the political system of a particular country is stable. So in any case of political instabilities, this can make the investors lose interest and confidence in that country's economy, whereby this will make them withdraw their funds from that particular country or resist from investing in it. By this can make the currency of that particular country's demand decrease and depreciate, whereby in the opposite side, when the political stability of a particular country is stable, the investors can be more convinced to go and invest in that particular countries, in a sense that they'll get more returns because people will have time to work and things like that. Political stability can also affect the policies that are going to be made, and that will affect their returns as well. We can see most of the countries which are having like civil wars, they have this political instability thing which will affect their exchange rate and their currency demand. Okay, moving forward to the fourth impact, which is inflation, whereby inflation can be say like the increase in prices of goods and services, which is caused mostly by the demand pull, cost push, and the monetary policies that are around that country at the particular time. The high inflation rates can reduce the purchasing power of the currencies, making it less desirable by investors and leading to this depreciation of that particular currency. This inflation we can see on what's going currently because it has made the as we can see, like for instance, the deal which has been made by China and Brazil, whereby they have decided to make the purchase using the yuan currency. So this is just one of the factors whereby inflation can cause the depreciation or the effect in the exchange rates of the particular currency. Okay, moving forward to the fifth factor, which is trade balance. What is trade balance? Trade balance is based and the import of goods and services between the country, whereby this determines the country's current account, whereby mostly when the current account of a country is negative, that means they have more imports than exports, and vice versa. When it's positive, that means they have more exports than imports, and the current account of the country is more better when it's positive, whereby this can impact their foreign exchange rates in a fact that if they have a positive current account, that means they have trade surplus. And that in that sense, their money will be more demanded in making purchases, whereby it will increase its value in relative to the other currencies. Okay, moving forward to the last impact discussed in this presentation is central bank intervention. Central bank can also influence foreign exchange rates by buying or selling its own currencies on the exchange market in order to stabilize its value. For example, the central bank may buy its own currency if it depreciates too quickly, or sell its currency when it appreciates too quickly, so that it can maintain the value of its currency. Okay, moving forward, I'm going to hand it to the person presenting the next part. Thank you.
All right, thank you, Esther. Good day, Miss. I'm Joanna. Now I'll be presenting about the effects of changes in foreign exchange rates. So the first effect would be financial statements in foreign currency must be translated, whereby companies with foreign subsidiaries must be translated their financial statements into the reporting currency. Therefore, changes in exchange rates can actually have the impact on reported financial results, such as income or expenses. And besides that, when the reporting currency strengthens against the foreign currency, the reported financial results rise. What happened?
Why was the recording stopped?
I don't know. I was just presenting only.
No, it was stuck. Like we didn't.
And
It
Esther
was.
is not here.
It stays here.
Esther's there? I can't see.
Joanna, you just edit the part. No need
So
to
I
start
cut
from the
and
beginning. Yeah, you start. Now you start. Esther, you got the Esther part, right?
yeah, now wait, let me stop or pause. Hi, good day, Miss. I'm Joanna. Now I'll be presenting about the effects of changes in foreign exchange rates. So the first effect would be financial statements in foreign currency must be translated. So whereby companies with foreign subsidiaries must actually translate their financial statements into the reporting currency, whereby changes in exchange rates can have an impact on reported financial results, such as income or expenses or assets. Moreover, when the reporting currency strengthens against the foreign currency, the report of financial statements actually fall. But when the reporting currency weakens, the reported financial results rise. The second effect would be cash flow implication, whereby companies that do business with foreign clients or suppliers may have transaction denominated in foreign currency. Exchange rate fluctuates might affect the value of these transactions, affecting the company's cash flow. Therefore, a strengthening of the reporting currency in relation to the foreign currency reduces the value of foreign currency revenues while increasing the cost of foreign currency payments. A weakening of this reporting currency, on the other hand, will actually raise the value of foreign currency revenues while decreasing the cost of foreign currency obligations. So moving on to the third effect, which is hedging techniques. Organizations can actually employ a variety of hedging strategies to manage their exposure to currency swings. Besides that, these hedging measures can help to reduce the impact of currency fluctuations on a company's financial performance. So for an example, the company may actually use forward contracts, options, or swaps to lock in exchange rates for future transactions. And the fourth effect would be competitive position, whereby changes in foreign exchange rates may have an impact on companies that compete with overseas corporation. Therefore, in a contrast, if a company reporting currency falls in value relative to the currencies of its competitors, then its products or services may become less expensive, making it more competitive in overseas markets. Therefore, in conclusion, I will say that changes in foreign exchange rates can actually have significant effects on a company's financial performance. Therefore, company must actually be aware of their exposure to foreign exchange rate fluctuations and implement strategies to actually manage their risk. So now I'll pass to Habib.
Thank you, Joanna. And for my part, I will start with the technique to minimize the foreign currency. In order for foreign currency to happen, when a business invests in a foreign currency that has been converted, must be converted to domestic currency, that's when the currency risk occurs. For example, like Coca-Cola, its headquarters is in United States, but yet it exports some of its products to different countries. So due to this, the company can have a fewer dollar in revenue as a result of international sales if currency fluctuate in other countries. Also, in this, I will discuss the techniques to minimize foreign currency. I will discuss on diversify globally, invest in currency hedging, also trade carefully with foreign bonds, and also invest in country with strong currency. Next slide. So starting with the diversify globally. Diversify globally is the process of compose of unlike elements, like spreading investment around so that the risk or to any one type of investment is limited. Global diversification might be advantageous to the investors, like through the use of index fund which concentrated exposure to major currency areas such as US, the Eurozone, and Asia Pacific. You should not concentrate on only one index fund. So diversify means you go maybe invest in US, Eurozone, and Asia Pacific. Also, with this level of diversification, you are already incorporating a natural hedging in your portfolio. Non-dollar asset gain when dollar is strong, and when non-dollar asset perform poorly, dollar-based investment perform well. For example, let's say Japanese yen. When Japanese yen is stronger than dollar, it's better to invest in the Japanese yen. This is diversify globally. Next slide. Next, I will talk trade carefully with foreign bonds. Like Esther explained, during the period of low interest rate in established countries such as the United States, many of investors look for opportunities in foreign market. But this can be different when it comes to bonds. This approach is very dangerous when it comes to foreign bonds. The rising value of dollar relative to the currency of the bond, as well as the bond future interest payment, will affect the price of your foreign, which will cause the dollar to be worth less in today's market. Given this risk, investors should carefully avoid or study on foreign bonds. Next slide. The last is invest in currency that are strong. When investing on a national level, look for country with a strong growing currency. For example, USD, which is very strong compared to many other currency. In other words, these currency are more powerful than the national income, the national currency. If the foreign currency exchange rate rises further, the investment will be worth more in local currency. So let's say we are in Malaysia and we invest in dollar, and the dollar become more stronger. So if we invest in that dollar, we will get more dollars because if we invested in a strong currency. And one thing that can determine the currency is strong, look for the country with low debt gross domestic product, because high debt level lead to inflation, and high inflation affect the currency. So it's better to look for the country with low debt to gross domestic product. That's all from my part. I would like to welcome again Ahmed for the conclusion part.
So in conclusion, as the hub of the financial markets, offering funding, investment opportunities, and serving as a link between all other financial markets, the foreign exchange and money markets are worth trillions of dollars. The significance of the money markets has increased in recent years as financial institutions pay closer attention to the management and diversification of their sources of liquidity, exercise greater discipline when raising money, and consider the benefits of short-term investment and trading strategies. Moreover, in this presentation, we hope that we have covered the factors that contributed to the patterns change in foreign exchange. the effects of changes in foreign exchange, and the techniques to minimize foreign currency expose. Thank you very much for listening to our presentation. Thank you, Ms.